Assalamu alaikum, everybody. Said I'm back again with another YouTube video. Today's YouTube video, guys, we're really going over part something of the course. I again forget what part it is. I think it's part 6, maybe it's part 7. But yeah, I'm still day trading, guys. Today it's 10:34 in the morning, so I'm day trading while making this course about trading for you guys. So if you guys like this course, guys, like the video, comment down below, subscribe to the channel, share it with your friends and family. I mean, shout my YouTube channel name on the top of the mountains or whatever. Do something to support because it takes a lot of effort, takes a lot of time, even takes a little bit of money to make these courses, make these YouTube videos out there. So if you appreciate it, do those things. That being said, guys, let's get into indicators. So a lot of you guys, if you're a beginner day trader, you're probably interested in indicators because indicators, let's be honest, they make things easy. So today's YouTube video, guys, I will be going over how to, well, what my favorite indicators are, how I use them, and just some tips and tricks about them. So yeah, also if you're wondering why I'm showing my ears, it's so that I don't start speaking so loudly because my ears are covered. You guys get it. Anyways, so in order to add indicators, guys, this is TradingView, my go-to charting platform. You're just going to go to the indicators tab and you're going to type in indicators. We're going to just go with the very first indicator. We're going to go over moving averages. Now mine is actually set to 200, so we'll just set it to 9. So moving averages are very, very important. And they're literally exactly as the name sounds, right? They're going to be an average of the last whatever period you set the moving average to. And it's going to put a line on there and it's going to tell you, hey, the average price for the last 9 candles is this point, right? So if you look over here, right, this candle, this line, this is the candle and this is the line, right? The white line. The white line is indicating to you what is the average of the last 9 prices, the averages of the last 9 candles, right? And it goes off the moving average close or the candle close. So price closed here, price closed here, price closed here. You notice price was closing down, down, down. Hence why the moving average is above price, but it's also going lower and lower because price keeps on closing in a downwards fashion. So the moving average, the average is always going to be down. And it's going to continue moving down as long as price keeps on closing below. Hope that makes sense to you guys. So moving averages are pretty important, guys, because again, they're telling you the average price and the average of what price has done over the last X periods. And that can tell you what price is going to do because it can determine the trend. Now, here's how you determine the trend. Price is above an M moving average, it's, a bullish trend. If price is below, it's in a bearish trend, right? Look over here. For the most part, price was above the moving average, we were in an uptrend. Price is below the moving average, we're in a downtrend. So for periods of 4 to 9, EMA periods, we're going to go over 4 to 9, right? So 4 to 9, we're going to be short-term trend, shorter term trend, right? From periods like 20 to 50, it's going to be medium trend. And then for longer exponential moving averages like 200 period, this is the longer term trend. All right. So if you guys want, you should definitely write this down. You should definitely take notes, take a screenshot, whatever it might be. And again, very, very important. Now, you guys might be wondering why 4 to 9? What about like 10 to 19? Why do we jump from 50 to 200? What about like 104? Guys, at the end of the day, all right, these numbers are the most common ones, okay? And they tend to work really well. So why would you switch that? Like, yes, you can make a 150 period moving average exponential, but why would you do that? Just go to the 200, right? It works the best. A lot of people use it. There's a reason people use it, okay? So these all the shorter term trends, the medium term trends, and the longer term trends. Now, you'll notice in the short term trend, it works out pretty well, right? We're above price, price is above the moving average, we're in an uptrend. Price is below the moving average, we're in a downtrend. But, sometimes it doesn't work out so well. Like you'll notice over here, if you just traded off this 9-period exponential moving average, you would get chopped out pretty quickly. Like you'd be buying over here, selling over here, buying over here, selling over here, buying over here, selling over here. You have a decent sell-off right over here. Buy here, you get lost. Buy here, decent buy position, but you probably close it out or break even or loser. You get what I'm saying? Like you're getting chopped out a lot. And over the long run, is it going to work? Yes, because you can catch trends like this. You can catch trends like this, right? So it does work out really well. But, it's a shorter term trend, guys. The shorter you go, the more choppy it's going to be, the less reliable it's going to be. Hence why we can now change our moving average, or we can just add another one, let's say, to the medium term trend and the longer term trend. Okay, so let's say the medium term trend, we're going to put it at 20. All right, and we're going to make this blue. Okay, and the fast, we're going to make it red. So the 9 period is going to be the shorter term trend, the faster trend, and we're going to make this red. Okay, and the overall trend is going to be the 200 period exponential moving average, and we're going to make this white. Now I've talked about the 200 EMA, right, in the last video, and you'll notice it works out really well. Overall, we're in a downtrend. Point blank period. Overall, we're in an uptrend. Prices above this EMA, we're going up and up and up, right? It works out really well. The 9 EMA, however, right, it works out well too, the red one, but you're getting chopped out a lot. So how can you use both of these EMAs? How can you use all three of these EMAs, the medium-term trend as well, to take a trade? Well, it's very simple. If every single EMA is telling you and it's pointing in the same direction, so in this case, every single EMA is pointing to the downside. Well, look how well that does for you, right? When does every single EMA start to point to the downside over here? At this candle over here. So from this candle here, you can catch this short. And look what ends up happening. We cross above. So now the faster moving average is above the solar one, right? The 9 period is above the 20 period. So this is telling you that, hey, in the medium trend, in the shorter term trend, there's a little bit of a pullback. There's a lot more bullish momentum. The overall trend is bearish, correct? But the medium term trend, the shorter term trend is telling you that we're probably bullish now. So do you want to be in shorts here? No. Because where do trends start from? Trends start from the bottom. Trends start from the smaller time frames. So the smaller time frames, if we're shifting bullish, maybe we shift bullish for the longer term time frames eventually as well, and we end up shifting from a downtrend to an uptrend. So you don't want to take trades during this period, right? You want to be cash. You want to make sure that all of your trends are aligned together. And we're going to talk about this in a future video as well. It's very important. But you'll notice again, when we close below, and the 9 period is below the 20 period, and the 20 is below the 200, what do you get? You get a very, very strong downtrend, right? So you can catch this literally from here to here. Oops. Come on. Catch this from here to here, right? Oh, now we're above. We're going to stop that. Oh, what happens over here? We go above, we go below again. And what do you see? Catch a really strong trend. You get what I'm saying? And this is one of the reasons why when the 9 is above the 20, even if we're below the 200, we're not taking trades, right? Because of the fact that the trends always start from the bottom trend. The trend always starts from the lower time frame, right? So if in a lower time frame, we're in a different trend than the higher time frame, maybe we're going to shift trends. And you'll notice that's exactly what ended up happening here, right? We were in a downtrend. The lower time frame trends ended up shifting to an uptrend, right? The faster EMAs ended up being above each other, and price ended up going above these fast EMAs. Overall, we're in a downtrend, but overall, eventually, all these EMAs were above price, were below price. Price is above all these EMAs, and guess what? We shift to an uptrend. So that's why you always want to make sure, guys, all of your time frames are in alignment. All of your EMAs are in alignment. When your longer term trend, when your medium term trend, and your short term trend are all in alignment, which means all of them are pointing in the same direction, all of them are telling you something, chances are, guys, you're in a very good spot, and there's a very good chance that price is going to continue in the overall direction of the trend, right? Overall, what do you see overall? Overall, every single EMA is pointing to the downside. Every single EMA is telling you to go short because price is below those EMAs. What ends up happening? We start going shorter and shorter. We start going lower and lower. Price ends up giving you a very good sell opportunity. What happens here? Every single EMA is telling you that we're most likely in an uptrend, and price gives you a very good long opportunity. Okay, so the easiest way to use these EMAs, if you want to use multiple confluences, would be for an uptrend, right? So there's two different ways. You can either look at the price itself and look at how price is in comparison to the EMA. If price is above the EMA, that means we're in an uptrend. Price is below the EMA, we're in a downtrend. Or you could do it like this. In an uptrend, you can look at the EMAs themselves and forget about price. If the 9 is greater than the 20, and the 20 is greater than 200, we are in an uptrend. And for a downtrend, if the 9 is less than 20, which is less than 200, we are in a downtrend. Point blank period, right? So you notice the 9 period is the red one, the blue is the 20, and the white is the 200. 9 is greater than the blue, which is the 20. 20 is greater than the 200, which is the white. We're in an uptrend. All right. You notice it works pretty decently. All right. I mean, market was kind of choppy over here, but you'll notice over here, right? It gets you out of the very strong drawdowns that ends up happening. Over here, are we still in an uptrend? Maybe not, because the 9 is below the 20, right? The red is below the blue. So we'd be out of the market over here. But guess what? The 9 goes above the 20, the red goes above the blue, right over here. Are we in an uptrend? Yes, because 9 is greater than 20, which is greater than white. And just look at the colors. Red is greater than blue, which is greater than white. And guess what? We start to go up. All right, let's look at this in a downtrend. So in the downtrend, the 9 has to be less than the 20, which has to be less than the 200. Red has to be below the blue, and the blue has to be below the white. Do you see this here? Yeah. What do you see? We catch this massive downtrend. So EMAs are really, really good, guys, for catching trends. Very, very good. And they're very objective. They're very, like, it's very simple, right? Just look at the EMAs. Are they below each other? Are they above each other? You can tell the trend, right? Very simple. Let's look at RSI for a second. Now, relative strength index. This is the default period. You've probably seen this before as well. Relative strength index pretty much tells you guys how strong a trend is. All right, now there's two ways to use this. If one, you see this 50 line over here that I'm pointing to, if we're below this, chances are we're going to continue going lower. And you notice what ends up happening. Right over here, right, we go below the 50 period exponential moving average. What ends up happening? We go lower. Right over here, we go below the 50 period exponential moving average. What ends up happening? We go lower. Over here, we're below the 50 period exponential moving average, we go lower. Now, obviously, the opposite works as well. If we're above the 50 period, chances are we're going to go higher. And we have a slight high over here. We go slightly higher over here. Over here, we go slightly higher, but nothing too crazy, right? Because the overall trend is in a downtrend, guys. So we're not looking to take buys in a downtrend. But what we are looking for is shorts, right? And I told this to you because guess what? The EMA, the 200 period exponential moving average in a downtrend. So we'd only be looking for shorts, okay? Because the trend is your friend. So what do you see? Where price has gone below the 50 period exponential moving average right over here, and we go even lower, right? When does price come back above and then goes below the 50 period exponential, not the 50 EMA, sorry, 50 on the RSI. Look at it right over here at this candle. This candle closes, we're below the 50. What do we have? A massive downtrend. We go above the 50 right over here. When do we go next? Right over here. What do we get? What do we catch on this candle right over here? A very strong downtrend. So you can use this, guys, in the overall trend to tell you, hey, the trend is now continuing, right? If we go below the 50 on the RSI, we're going to go lower, right? So let's look at this. I don't know why this number works out, but RSI. Below 50, downtrend. Okay, and then if we're greater than 50, we're in an uptrend. As simple as that. Right, now let's look for the uptrend values, right? What do you see over here? So we're above the 200 period exponential moving average. Now we're in an uptrend. So what do you see? Price dips below the RSI 50 value right over here, and now we're above it on this value. This candle right over here. What do you see happens after price goes above the 50 period, 50 value on the RSI? We go higher. Same thing over here. Price dips below right over here, comes back up over here. Okay, now we're above the 50 period, 50 value. I keep on saying 50 period, but you'll notice a little bit of chop, but overall we go higher and higher and higher. Okay, come on, why is this not working? Higher and higher and higher. So you can use the RSI very well, guys, in line with the trend. Look, we dip below the 50 right over here. Dipping below the 50 right over here. When do we close back above? Right over here. So above the 50 value on the RSI right over here, what do you see? Massive strong trend. Very, very simple stuff, guys. Now that's one way to use the RSI. The other way to use the RSI, guys, is going oversold and overbought. It's a very, very common way to use the RSI. So what you'll notice is that there's 2 points, right? This is the high value and this is the low value. The high value tends to be 70, the low value tends to be 30. You can play around with this as well, right? So one thing is to look for shorts. Okay, short when RSI less than, or I should say greater than 70, and long when RSI is less than 30. Right? So you'll notice, when is RSI above 70? Look at this. Are we above 70 over here? Yes. Where are the values, guys? Over here, in case you're wondering. We're above 70 over here. What ends up happening? Massive short. When do we go below 30? Right over here, right? Look at the RSI right over here. On this candle right over here, we're below 30. What ends up happening? Massive uptrend. So why do you think we're going? What is this telling you, right? What is the RSI telling you when we're above 70, when we're below 30? Well, if the RSI is a very good trend indicator, telling you that, hey, momentum is stepping, it's a momentum indicator, I should say, that momentum is going higher and higher and higher. Well, at one point, we're not going to be in an uptrend forever, right, guys? In this scenario over here, we're in an uptrend, right? But we're not going to keep on going higher and higher and higher. Stocks don't work that way. Forex doesn't work that way. Futures doesn't work that way. At one point, we're going to pull back. At one point, we're going to go lower. So when we're above 70, on the RSI, that means we're overbought. There's too much demand. Oh, sorry, there's not too much demand. There's too much buying pressure. The market can't sustain it anymore. And when we're below 30, like we were over here, we're oversold. There's too much selling pressure. The market can't sustain it anymore. So if you're looking to buy, are you going to buy at the highs when a lot of people have bought? No, you want to buy at the lows, correct? So when is the low? When there's too much selling pressure. And now guess what? Market has gone so much lower. So now you're going to buy because now you're buying at the lows, right? And again, let's go do the opposite. Are you going to sell at the lows or sell at the highs? We're going to sell at the highs. How do you know it's the high? When there's too much buying pressure. How do you know there's too much buying pressure? The RSI goes above 70, all right? So are we short when RSI is greater than 70? Why? Because that means the RSI equals overbought, right? RSI equals overbought. I wish I could spell. And when RSI is below 30, that means the RSI is oversold. All right. This is another way to use the RSI, guys. So you can use this for momentum and going in line with the trend, or you can use this to go against the trend, right? Now, do I recommend that? No. But guys, overall, you can't just start buying when RSI is below 30 and selling when RSI is over 70. All right. That's not going to work all the time. You'll notice over here, if you started selling over here, it would have worked out a little bit, but most likely you would have get it stopped up, right? And again, over here, like, okay, let's see if I can find another one. Like again, okay, over here, like you would have sold and works out for a little bit, a very tiny bit, but then overall you get stopped out. So it's not going to work all the time. Like anything else, you have to couple it with other things. All right. So we've gone over the EMA, guys. We've gone over the RSI. Let's go over another indicator. One of my favorite indicators to use, ATR. Now you might be wondering, Syed, what the heck is this ATR? How do I use this? Like I've never seen this before. All right. And it's not really telling me anything. This is a trend indicator. No, this is honestly one of the most important indicators that I use on a daily basis whenever I'm trading. And it's going to be the ATR, average true range. That's what it stands for, average true range, right? And this pretty much tells you for the 14 periods. So for the last 14 candles, what is the range of the candles? The ATR, average true range, right? So this is telling you, like over here, right? The values are always over here, guys. That at this candlestick right over here, the average value was 136 pips for each candle, which means that each candle is roughly moving 136 pips. So if you want to buy over here, right, and you're very confident that you want to buy over here, well, if the average candle moves 136 pips, well, actually, let's say in this scenario, right, if you're buying at this candle, the average is 125 pips, okay? So if the average candle is moving 125 pips in either direction, is it a safe space? Is it safe for you to put your stop loss at 70 pips? No, right? Because again, a candle can move 70 pips in one direction and 70 pips in the other direction and take you out and still be going with the overall trend. Makes no sense, right? So in order to safely put your stop loss somewhere where the candles are most likely not going to reach, we're going to use the ATR. And likely we're going to use 2 times the ATR, right? So now look, 250 pips is your stop loss in this scenario over here. Let's say you're taking a long position over here for whatever reason. Is this safe? Is this stop loss safe? Of course it is. Because what are the chances that price moves double the average of what prices have already moved? Very little. So if you're right on the trend, if you're right on taking a buy position over here, for whatever reason, then you're not going to get stopped out if you use 2x of the ATR. That's usually the average stop loss that someone's going to use when they use the ATR for the stop loss, right? Because again, prices are moving 125 pips. Candles are moving 125 pips. So it's very normal for a candle to move 120 pips, like so, and then go to the other direction. It can happen. Every single candlestick, guys, whether it's a bearish candle or a bullish candle, is going to be bearish at one point, bullish at another point, unless if it's an engulfing pattern, right? Look, even this candle over here, look at how strong this bullish candle is. Look at how strong this bullish candle is. But at one point or another, it was bearish. I left this tiny bit. Look at how strong this bearish candle is. At one point or another, it was bullish, right? Every candle moves in one direction or the other. It's going to move in both directions most of the time, right? That's what's going to end up happening. So to avoid you getting whipsawed out, to avoid you taking losses when you shouldn't, you use the ATR. That's the whole point of the ATR. It's a stop loss indicator. It's going to help you with placing your stop loss. And this is one of the most important indicators because it helps you manage your risk properly and avoid getting whipsawed out of the market. So you can take trades, you can be confident in your stop loss. All right. This is another very, very smart indicator, very important indicator. Right. Now, trying to think. I'm trying to keep these indicators to the most basic ones, guys, because you'll notice that you just need basic indicators. You don't really need anything crazy. So I don't think anything more than this is actually very valuable, but we could go to another one, which is a relatively simple one that I really like. And we're going to go to the SSL channel. And we're going to shift this into the 21 period. Or the 10 period, I should say. It's at the 21 already. Cool. So this indicator is pretty simple to use, guys. You can probably tell by now. Okay? Red over the green means you're in a downtrend. Green over the red means you're in an uptrend. This indicator is very, very good for entries. Okay? Very, very good. You'll notice, guys, right? What happens over here? Green crosses above the red. Would you be looking for shorts? No. You're only looking for shorts when red is above the green. So you'd be out of the market over here. Green crosses, red crosses above the green, you're looking for shorts. Green crosses above the red, you're out. Red crosses above the green, you're in. And you'll notice, guys, it's getting you in the trends really well, and it's getting you out of the chop. Gets you in the trends, gets you out of the chop. Right over here, right? Let's look over here. Gets you in this trend, gets you out of the chop. Super duper chop, right? So you'd get stopped out over here a lot. But guess what? Overall, gets you in another trend. Right over here. Takes you out of the chop, right? We're in an uptrend now, so I'm only looking for buys. Right? Gets you in the trend. Gets you out of the pullback. Gets you in a trend, gets you out of the pullback. Gets you in the trend, gets you out of the pullback. So you'll notice this is very, very good, guys, at catching what? Trends. So this is an entry indicator. There are different types of indicators, guys. There's going to be indicators that measure for momentum. There's going to be indicators that measure the trend. There's going to be indicators that give you an entry. Indicators for like stop loss, like ATR. All right. I've given you the trend indicators, which is the exponential moving average. I've given you the stop loss one, which is the ATR. The momentum one with the RSI. This is going to be your entry indicator, guys. All right. Very, very good entry indicator. This is going to tell you, like, hey, when red has crossed over the green in a downtrend, you should be looking to enter shorts. When green has crossed over red in an uptrend, you should be looking for longs. Very simple. And you'll notice, guys, that this works out pretty well, pretty decent. Right over here, green crosses over the red, bam, we're in an uptrend, takes you out over here. Green crosses over the red, then we're in an uptrend. Okay, this probably would have been break even or a little bit of a loss. Over here, you'll notice, guys, no indicators are perfect, so you're going to get chopped out sometimes. But overall, you can catch pretty good trends. Right? Bunch of chop over here, get stopped out a little bit. A lot of chop over here, but guess what? Green crosses over the red, okay, and you're catching this massive trade. Pretty good indicator, right? This is your entry indicator, guys. I don't think I have to say much more than this. Then when the green crosses over the red, this is the SSL channel, by the way. SSL channel, green greater than red, buy. Red greater than green, sell. Pretty simple. There's two different ways, guys. You can use the 10 period or you can use the 21 period. Like so. Now you notice, guys, with the 21 period, did it change? Yes, it did. Okay. You notice with the 21 period, guys, you're getting into the trends a lot better. There's a little bit less chop, right? Overall, you'll notice that there's less chopping happening. However, you're also going to miss out on trades. So again, it really depends. This is a medium-term SSL channel in comparison to the shorter-term SSL channel. Shorter term will get you more trades, but more chop, so you're going to get stopped out more. Longer term will get you into less trades, but you're going to catch a lot more trends, and you're going to get less trades as well. So it's really dependent. I didn't really say much on the SSL channel, guys, because quite frankly, it's pretty simple to understand, and it's very easy to use. So using all the indicators that I've shown you today, guys, you can just formulate your own. You can formulate your own your own strategy. Now you'll notice, guys, I give you some indicators. I didn't give you all of them, right? But these are the very basic indicators, and it can build a good framework for taking trades, right? How would you use this for a strategy? How would you build a strategy off this? Prices below the 200 period exponential moving average, all right? Guess what? Take a short position when the SSL green is below the red and RSI is below the 50. What happens over here? All of these, okay? So what ends up happening? Take the short right over here. All of these things match up. Now you're going to put your stop loss at double the ATR. So what's your stop loss? What's your ATR? Sorry, 57 pips, right? Call it 58 pips. So what's your stop loss going to be? 106 pips, roughly. Right? And guess what? You get stopped out. That's okay. Every single strategy will get stopped out. But you get another entry right over here. Red is over the green. Price is below the 200 period EMA. RSI is below 50. Look at that. Enter right over here. What's your ATR? 48. Okay. What's your stop loss going to be? 96 pips. And then bam. What do you catch? You can catch a 1 to 2.5. Easy. Easy money. Come on. 96 pips. Bam. Easy money. And what is that? Look at that. It just keeps on going lower and lower. But guess what? Maybe you want to be smart about this. So catch your 1 to 2 and get out, because your price isn't always going to continue going lower and lower like this, right? Sometimes you're just going to not be able to catch prices that low, right? But guess what? We get another trade on opportunity right over here, right? Right above the green, prices below the RSI, 50, right? Double your stop loss, 60 pips. Cool. You have 120 pip stop loss roughly there. Catch your 1 to 2 and you're out. When you catch your 1 to 2, right over here. Very, very simple stuff, guys. Again, sometimes you get stopped out, right? Bam, stopped out right over here. This is going to be a loss, right? We have the same things. It just, your stop loss is going to be right over here roughly, and you just get stopped out. It's going to happen. What happens over here? Another entry. Okay, let's take it. What's your stop loss? 67. It's 134, something like that. All right. So this one, you want to hit 1 to 2. I would move my stop loss to break even, guys, after 1 hour, because there's no reason to be in a trade. After you've already made your risk, just move your stop loss to break even. Again, another opportunity right over the green, RSI below 50. Double your stop loss, double your ATR for your stop loss. Bam. 1 to 2 hit. Look at that. 1 loss, win, up 3R, loss 2, break even, plus 2, plus 4R. 4R in like the 6 trades that I took. This is how you can use your strategies, guys. Now, this is a 21 period EMA, SSL chart. Sorry. Maybe you change this to a 10. Maybe instead of the 200 period EMA, just using that, maybe you had the other EMAs, the 9 and 21 as well. All right. Maybe instead of using the RSI for momentum, using with the above the 50 and the below the 50 will, maybe you use the oversold and overbought, right? Maybe instead of 2x ATR, you use 1.5x ATR. Guys, I just gave you a random strategy. I don't know if this is going to work over the long run. I don't know. I'm not going to be a liar to you guys and say this is a 100% profitable strategy. Use this and make a lot of money. No, but guess what? Is it working decently well right now? Yeah, look at this. Green above the red, prices above the 200 EMA would end an uptrend. Okay, RSI is above the 50. Okay, what's your stop loss? About 100 pips. So your stop loss is, your ATR is about 100 pips. So your stop loss is going to be around 200. Target of 1 to 2. Does this hit? No, it doesn't. But we're at 1 hour. So we move our stop loss to break even. And we get to out of break even. It's working decently well. It's not going to work all the time, of course, but sometimes it will. Would you take this trade? Yes, you would. Right? Because green is above the red. Okay, ATR's 86. So you're going to have double the ATR. You get stopped out here. It's okay. It's going to happen. Right? Everything else was in line with the trade. You get another opportunity over here. RSI above 50. Price above the 200 period EMA. Green is above the red. What's your stop loss going to be? 200 pips roughly. Okay. What happens over here? What happens over here? Do we hit take profit? It doesn't seem like we do. We get took out of break even before we do. But guess what? We get another entry over here. Right? Another entry, and then this one definitely hits take profit. I can guarantee you that much. 130, yeah, it hits take profit before here. Right? Again, green over above the red, RSI over 50, price above the 200 EMA, double ATR as a stop loss. Simple strategy, guys. Is it making money? In this scenario, yeah. Is it going to make money over the long run? I don't know. I literally couldn't tell you if it's going to make money or not. But between all the trades that I showed you, the 8 trades I showed you, it's made 5% or something like that already. 8 trades, 5%. There's 2% of your account, you made 10% in 8 trades. Again, you have your trend, you have your momentum indicator, you have your entry indicator, you have your stop loss indicator. What more do you need? This is how you build a strategy, guys. And I'm going to go over that in the next video as well. But if you guys like this video so far, about tutorial of my favorite indicators, guys, I show them what the indicators are, how to use them. Now it's up to you to test them, right? Test them out, see if they work well. Maybe you want to change the period, right? Maybe you want to change the settings of the indicators. Maybe you want to not use one of the indicators. Maybe you liked one of the indicators. Now it's time for you to test them out, right? It's up to you. These are my favorite indicators, guys. And they're the overall indicators I use whenever I'm building a strategy. Sometimes I'll switch one out for the other or whatever it might be. But overall, I love to use a 200 EMA for trends, the ATR for stop loss, right? As for momentum and RSI, and entry for SSL. I sometimes move them around, switch them around with other indicators, but these are my favorite. So I gave a strategy to you guys. Now it's up to you to figure out how to use it. It's up to you to test these indicators out. If you like this video, guys, like the video, comment down below, subscribe to the channel. With that being said, guys, assalamu alaikum.